You ever wonder how some families manage to pass on millions and pay almost nothing in taxes? You might think it's some secret offshore account or a billionaire loophole, but actually it's something most people have access to, and it's completely legal. It's called using life insurance to pass wealth tax-free, and today we're going to break it down in a simple, real-world way. No jargon, no hype. Just the why and how behind one of the most powerful wealth tools in existence. Most people spend their whole lives working, saving, and trying to build something for their families. But when the time comes to pass it on, the government steps in, takes a huge chunk, and what's left isn't what you thought it would be. Estate taxes, income taxes, capital gains taxes, it adds up. But what if you could legally transfer that wealth without it being chopped down by taxes? That's where life insurance, used the right way, changes everything. Before we dive deep, if you enjoy learning about strategies that help you protect and grow wealth, take a quick second to like this video to support the channel, and subscribe for more content that helps you think smarter about money, investing, and legacy planning. And know that none of this content is tax or financial advice, but educational only. Do your own researches or consult a professional to know the rules of your jurisdiction. All right, let's get into it. Let's break this down step by step. 1. Understanding the problem, the hidden tax trap. Here's something most people don't realize. When you die, your assets don't just quietly go to your loved ones. They go through something called your estate. And depending on your country, the government might tax that estate, sometimes up to 40% or more. That means if you built a $2 million nest egg, your family might only see about $1.2 million after taxes. Now think about it, that's decades of work, savings, sacrifice, and nearly half disappears. This is why wealthy families and smart planners start looking for ways to move wealth outside of the taxable estate. And that's where life insurance comes in. Not as a death benefit alone, but as a transfer vehicle. 2. The concept of life insurance as a wealth transfer tool. Life insurance is unique because of one simple rule. The death benefit is generally paid out tax-free. That means when the insured person passes, the policy's payout goes directly to the beneficiaries without income tax. And if structured properly, it can also bypass estate tax. Now, there's a difference between using insurance to replace income and using it as a tax-efficient asset transfer. This second use is what wealthy families quietly use all the time. They use policies not because they need coverage, but because they want to move wealth efficiently without triggering tax events. 3. The mechanism of how it actually works. Let's imagine this. You have $1 million in investable assets. You could invest that, grow it, and when you pass, your heirs inherit it, but taxes could take a big bite. Or you could use part of that money to pay premiums on a permanent life insurance policy, like whole life or indexed universal life. The policy grows, and upon death, it pays out a much larger amount, often 2 to 3 times what you put in, completely tax-free, so you've turned taxable wealth into non-taxable wealth. But here's where it gets smarter. You can even place the policy inside an irrevocable life insurance trust, or ILIT for short. That means the death benefit doesn't count as part of your estate. It's fully outside of the tax net. Your heirs get the benefit directly, quickly, and privately. No probate, no estate taxes, no delays. 4. The personal versus the trust ownership path. There are 2 main ways people hold these policies. Path 1. Personal ownership. That means the person insured also owns the policy. It's simple, easy to manage, but the death benefit is included in the taxable estate. Path 2. Trust ownership, the ILIT we mentioned. This is more advanced, but it's how wealthy families do it. They create a trust, the trust owns the policy, and the trust names the beneficiaries. So when the payout happens, it doesn't even touch the taxable estate. It's like sending money through a side door, quietly, legally, efficiently. 5. The compounding benefit of cash value growth. Here's another layer that's often overlooked. Some life insurance policies, particularly whole life or indexed universal life (IUL), have a cash value component. This cash value grows tax deferred. That means it compounds without you paying taxes along the way. You can even borrow against it, tax-free, during your lifetime. It's like building a private bank that you can access, while still keeping the death benefit in place for your heirs. So not only are you passing wealth tax-free, you're also growing it quietly in a tax-sheltered space. 6. The strategy in action with a simple example. Let's make it real. Imagine Sarah, 55 years old, with $500,000 she doesn't need for retirement. If she just invests it, that money will likely be taxed as it grows, and her heirs might face estate or capital gains taxes later. Instead, Sarah uses that $500,000 to fund a permanent life insurance policy inside a trust. Her policy provides a $1.2 million tax-free death benefit. When she passes, her children receive the full $1.2 million, immediately, privately, and completely tax-free. Now think about that. Sarah didn't just save on taxes, she amplified her wealth transfer by over double. And all of it happened using a simple, predictable structure that's been around for decades. 7. Some common misconceptions. A lot of people hear life insurance and think, oh, that's just for people with kids or debts. But in reality, for those thinking long-term about legacy, it's one of the smartest tools available. Another misconception? That's only for the super rich. Not true. Even middle-class families use smaller versions of these strategies. Not to dodge taxes, but to make sure what they've built stays intact. 8. The smart approach of working with the right structure. Here's the truth. The magic isn't in the product, it's in the structure. If you set up a life insurance policy without the right ownership or beneficiary setup, you could accidentally pull it back into your taxable estate. That's why it's important to coordinate with both a financial planner and an estate attorney. They help make sure the trust, ownership, and beneficiary details are airtight. This isn't about avoiding taxes. It's about planning intelligently within the rules. 9. Generational impact. When done right, this strategy can create something most families never experience: a tax-free generational handoff. Imagine your kids, and even grandkids, starting their lives with a foundation that isn't cut down by taxes or legal fees. That's what smart legacy planning looks like. And life insurance, and when understood beyond just coverage, can be the key that makes it possible. So let's quickly recap what we covered. Estate and inheritance taxes can take a big bite out of what you pass on. Life insurance provides a tax-free death benefit. When owned by a trust, it can also bypass estate taxes. Cash value policies grow tax-deferred and can be borrowed against. Structured right, it's one of the most efficient ways to pass wealth, quietly and legally. Now I'm curious, have you ever thought about using life insurance as a way to transfer wealth, not just protect it? Drop a comment below. I'd love to hear your thoughts or questions. And if you found this helpful, make sure to subscribe so you don't miss more deep dives like this one, where we explore the strategies that help you protect, grow, and pass on what you've built the smart way. Thanks for watching, and I'll see you in the next video.